The third principle is diversification. Now, everybody's heard about diversification. You always hear that in the media. You hear it from all the different brokers. Everyone talks about diversification. Everybody knows that you don't want to have all your eggs in one basket. But what I'm about to show you is some slides on how people really aren't that diversified. The other thing that this session is going to show you is that not only by diversifying can you reduce your risk, but you can actually increase your return.
So what I'm going to do to show you the importance of diversification and rebalancing is I'm going to look at 4 equity asset class portfolios from 1972 to 2003. Portfolio A is going to be 100% U.S. stocks. Portfolio B, 100% non-U.S. stocks or international stocks. Portfolio C is 100% real estate securities. And what I'm talking about here is investments in commercial real estate, such as warehouses, shopping malls, apartment buildings. And then Portfolio D is 100% commodities. And here I'm talking about the actual investment in oil, gold, livestock, grains, precious metals, and commercial metals. Now, there are essentially 2 major asset classes: equities and fixed income. Equity is where you're an owner. If you buy shares of Disney stock, you're an actual owner in Disney. If you buy commodities, you're an actual owner in the oil or the gold or the underlying commodity. Whereas with fixed income, which are typically bonds, you're acting like a banker. You loan money to Disney or the government, and they agree to pay you back your principal along with interest. Now, fixed income is typically less volatile than equities. When you own something, it can typically be much more volatile and up and down movements. So what I'm going to do is show you the importance of diversification by just focusing on equities. We're going to ignore fixed income right now, but I'll be able to show you that even with volatile asset classes like equities, that diversification and rebalancing is essential. So again, we're going to look at 4 equity asset class portfolios, no fixed income, over the period 72 to 2003. So looking at these portfolios, if we go on the vertical axis up, that shows you the compound annual return over that 30-year period. So the higher up we go, the higher the return. So you can see from this graph that Portfolio C, real estate securities, had the highest return, which was 13%, whereas international stocks was the lowest with just around 11%. Now, along the horizontal axis at the bottom, you have the measurement for standard deviation, which is also known as the risk. So the further to the right we go, the more volatile the asset class. So you can see of the 4 asset classes, commodities was the most volatile, and real estate securities was the least volatile. So now what we're going to start doing is combining these asset classes. The first thing we're going to do is create portfolio AB. That's going to be 50% of U.S. stocks and 50% international stocks. And what we're going to do is we're going to rebalance this portfolio every single year.
So rebalancing is essentially what you have is if we have 2 asset classes, 50% in U.S. stocks and 50% in international stocks, we start off at that 50-50 level. So then at the end of the first year, let's say U.S. stocks did better than international. So now all of a sudden our portfolio is 60% U.S. stocks and 40% international. Well, rebalancing means that we're going to sell 10% of the U.S. stocks and buy 10% of the international to bring it back to that 50-50 level. So you do this every year, so no matter what's happening, which asset class is doing better, it forces you to sell high and buy low.
So you can see portfolio AB actually performed a little bit better than U.S. stocks over that period with just a tad more risk. Now, what most people think is when you combine A and B, you should get a portfolio that ends up at the midpoint between the two. But that's not the case because of the rebalancing. The rebalancing allowed us to systematically sell when things were high and buy when they were low, and that gave us a little bit extra higher return. Now we're going to take it to the next step, and we're going to add real estate securities to this mix. So we're going to have portfolio ABC, which is 1/3 real estate, 1/3 U.S. stocks, 1/3 non-U.S. stocks. rebalanced every year to that allocation. And what you're going to find is from portfolio AB to portfolio ABC, we've increased the return and we've further reduced the risk. So we've gone from a return of about 11.5% to one of about 12.25%. And we've gone from portfolio AB having risk of 7.5 to 17.5 to 18.5 to having a risk of only 15.5%. So again, we've reduced risk and we've increased return by diversification. Now let's take it to the next step. We're going to go from portfolio ABC and we're going to go to portfolio ABCD, which is going to have 1/4 of each of the 4 asset classes equally allocated and rebalance annually. So what we're essentially doing is we're taking commodities, which is the most volatile of the 4 asset classes, and we're adding it to the mix. And what you notice is that from ABC to ABCD, we've actually reduced risk further and we've increased our return. Our return has gone from about 12.25% to 13%, and our risk went from 15.5% to about 11%. Now you might be wondering, why would risk go down when we're adding commodities, which is the most volatile or the riskiest asset class? And the reason is commodities have a low correlation to the other asset classes. That means that they might zig while the others are zagging. That's the key to diversification. When you put in different asset classes that are moving in different patterns, you typically end up with an overall return, an overall portfolio that has less volatility. That is most people know that you want to diversify to reduce your risk. Everybody's heard about not putting all your eggs in one basket. But what's amazing about diversification is it actually increases your return when you do an annual rebalance, because you're forcing yourself to sell high and buy low. So diversification not only reduces your risk, it increases your return. And that's very important.